a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Small cap growth ETFs are in focus here as we talk more about them with our ETF research director, Nina Mishra from Zacks.com. So the small cap stocks have been outperforming large caps lately.
Yes, and I think the biggest reason is the strength of the US dollar.
Really?
And even after the what I would call a temporary pause in the US dollar rally, after the dovish comments from the Fed last week, even after that, the dollar is up almost 7% this year against the major world currencies and almost 20% in the last 1 year. And that is a very fast rise in a very short period of time.
So how does that help the small caps versus helping the larger caps?
Actually, the dollar strength really hurts the larger caps because these companies derive a lot of their revenue from outside of the US. In fact, S&P 500 on an average gets 46% of its revenue from outside of the US. So the dollar strength not only makes the goods abroad uncompetitive, less competitive, it also reduces the value of their overseas earnings. And many of these large companies have been warning about the dollar strength, that the dollar strength is going to hurt their results, and it is already hurting their results, which we have seen in the recent earnings.
Yeah, I believe I heard that if it hasn't happened already, because I heard this a few days ago, but the euro and the US dollar could be trading at par.
Yes, as we said, as I mentioned, that we have seen a temporary pause in this rally, but I think the rally is going to continue because of this monetary policy divergence. The US Fed is getting ready to raise rates sometime later this year, but central banks in the Eurozone and Japan are still easing aggressively. So I think the dollar rally will continue, even though not at a pace that we saw recently, and the dollar will ultimately rise to parity with the euro this year.
And economic growth also plays into this.
Obviously, yes. Some of the recent economic data, including the new home sales and the inflation data, that points that the US economy has been firming up. The economy slowed slightly after last summer, and the brutal winter did not help either. But even then, US economy is doing much better than the rest of the developed world. Per IMF projections, US will grow at 3.6% this year versus just 1.2% for the Eurozone and just 0.6% for Japan. So in such a scenario, smaller, domestically focused companies, they are in a much better position to benefit from the improving US economy, and they are also shielded from the adverse impact of the strength of the US dollar. So it makes sense to take a look at them. And lastly, earlier, these smaller companies were not really known for paying any dividends. But of late, with the improving economy and also due to some pressure from activist investors, many of these companies have started paying dividends. In fact, per S&P Dow Jones, last year 325 small cap companies from the US 600 small cap index paid dividends, which was up 10% from the previous year. And S&P expects that more than 200 companies, small cap companies, will raise their dividends this year.
That's very interesting, too.
So that's another reason to look at these smaller cap companies.
Sure, everybody likes dividends. You have a couple of examples here. One is the iShares S&P Small Cap Growth ETF, the 600.
Yes, I have two examples, and both are Zacks rank number one, strong buy-rated ETFs. The first one, as you mentioned, is IJT. It holds about 350 stocks from 350 growthier stocks from the S&P 600 small cap index. Very popular ETF with about 3.4 billion in assets, decent trading volumes, charges 25 basis points in expenses per year. It has largest exposure to financials, IT, and consumer discretionary sectors.
And then the Vanguard Small Cap Growth ETF, VBK, right?
Yes. This is more diversified. It holds about 730 small cap growth stocks. It is also the cheapest in this space with just 9 basis points in expenses. It is also very popular with more than 4.4 billion in assets. Again, top sectors are financials, industrials, and consumer. And this is also a Zacks rank #1 ETF. Comparing these two ETF, IJT has a slight tilt towards smaller companies,
Okay.
including some allocation to microcap stocks as well. And because of this tilt towards smaller companies, it has been slightly outperforming the Vanguard ETF.
Okay.
But obviously, it is a little more volatile too.
What do we need to know about risk here?
Investors should note that these are smaller companies with higher growth potential, but they are riskier as well. So you should be prepared for more volatility with these stocks and ETFs, and they are more suitable for small satellite holdings in your portfolio, especially if you have a large allocation to large cap or large cap value stocks, which are like main part, the core part of your portfolio. Then these ETFs can be held as small satellite holdings, and they will provide a larger growth potential and diversification to your portfolio.
Okay, do you own either one?
I don't.
All right, if you would like more information, actually a wide variety of bigger menu of ETF information, you need to get over to the ETF section of Zacks.com. If you're not on the website already, you'll find commentary, you'll find profiles of individual ETFs in many different categories, written not only by Nina, but her staff as well. So what you do is get over to the homepage of Zacks.com and navigate to the ETF section using the Funds tab at the top of the homepage on that toolbar. With Nina, I'm Terry Ruffalo.